Welcome to this episode of Next Exit, where we speak to industry leaders to hear their advice on maximizing your next exit. I'm very excited to be joined today by someone who has had no fewer than 9 CFO roles in the past few decades and 3 exits and many more roles involved in restructuring in the run-up to an exit. Bob Gold, welcome to Next Exit.
Thanks for having me, Dan. Delighted to be here.
Fantastic. Before we kick things off, Bob, it would be great to hear about your background and how you got to where you are today in your career.
Oh, I'd be delighted. I actually started my career and got my foundation at a company called the Danaher Corporation. I spent 13 years with Danaher and moved through 10 different positions. I built a non-strategic division up and managed to sell it for Danaher. I moved through other positions where we focused on growth and working capital transformation, and I led the electronic voting systems division. I also did a lot of acquisitions and really cut my teeth on acquisitions and acquisition integrations while I was with Danaher, including the integration of a subsidiary in Paderborn, Germany, where I lived for 2 years. So I had a great career at Danaher. I left Danaher intentionally to go into private equity. I joined Jolly Gardner, was a late-stage investment for the PE fund. At Jolly Gardner, we really tightened up and built structure around the internal reporting and packaged the company for sales. So in about a 13-month period, we packaged the company up. Exit readiness is an incredibly important exercise, and successfully sold this company for the equity fund. I learned, this was my first PE deal, I learned that frequently the CFO is the first one out following a transaction. I was very quickly recruited into a company called United Plastics Group. United Plastics Group was a turnaround, global contract manufacturing company with plants around the world, 3 plants in China, 1 in Wales, 3 in Mexico, and 4 in the United States. We took a company that frankly was losing money, converted it from a contract manufacturer for automotive into a medical device manufacturer with marquee customers like Medtronic and Smiths Medical, and ultimately sold it as a medical device manufacturer. We went from a loss to about a 15% EBITDA and sold again very successfully. Coming off of that success, I joined Culligan following a debt for control transaction. The equity fund acquired Culligan, exchanging their debt for ownership. Culligan was a 2-year project, really doing balance sheet cleanup and building out a new team. Really top grading almost the entire team, as well as several people on the next layer down. I set Culligan on the right path, and then I left Culligan in advance of a transaction. Following Culligan, I actually went into aerospace and defense, which was, I will tell you, the best part of my career was in aerospace and defense. Incredibly rewarding. I worked for a defense electronics manufacturer, where we were supplying Lockheed, Sierra Nevada, and so on. One of the really interesting things I did there was we had an underperforming division that was really an orphan division, and I sold that off for the company. I ran the auction and sold it off. And while I was with and then I drove a lot of process improvement, which is kind of a hallmark. I consider it blocking and tackling and don't talk about it a lot, but I drove a ton of process improvement there. But I was actually recruited out of that company. It's called Atrin. I was recruited out of Atrin into a company called AM General. AM General manufactures the military Humvee, probably the coolest product to be affiliated with. And I had a ball at AM General. Opportunity for process improvement. I inherited a good team, top graded only a couple of positions, and we really drove a ton of process improvement. We built out a plan for localization of production in other countries. and really built great growth over the period I was there. Took them through a very successful transaction and stayed for a year and a half post-transaction. It was probably one of the highlights of my career, working with an outstanding team. One of the things that I loved the most about AM General was because we were selling a military product. We had a lot of veterans working for the company, and the opportunity to work alongside veterans is a privilege that I'll never forget. Some of the best people I've ever worked with. And moved on from AM General, went to work for my first healthcare company, non-manufacturing, called Eye Care Partners. That too was a turnaround. Restructured the debt there, drove a massive amount of process improvement in revenue cycle management, treasury management, and procure to pay, really driving cash flow improvement. And restructured a very onerous debt package. Once the restructuring was complete, I left. And then recently, I joined Pitney Bowes following a restructuring. I've since left Pitney Bowes, and I'm back out looking for my next project.
Fantastic. That's quite the list of achievements.
I've had a lot of fun.
Yeah, sounds like it.
And I've been incredibly blessed.
Yeah. Going back to a trend and AM General, you mentioned the caliber of people there. Would you say that that's because there's such the high density of military veterans? They bring that really high caliber of operational excellence, etc., into the private sector.
Yeah, that was certainly the case at AM General. You know, there's a level of discipline and structure that veterans bring to the table. I'll never forget, in my first week, we were out at the proving grounds where we exercise Humvees, basically, on different terrains. And I was talking with the gentleman who runs the proving grounds, and he's a vet. And I asked him what he loved about working with for the company, and he said, "I still get to work with soldiers."
Yeah.
So it's a real privilege.
Yeah, absolutely. Absolutely. And more broadly, it sounds like a lot of the roles you've had shorter in term. That obviously private equity CFOs, as you mentioned at the top of the show, when there's an exit event, quite frequently the CFO is the first to go. But also that means there's a lot of jobs to move into, I guess. But every few years you've been going into every new roles. And there does seem to be a theme. It's really aggressive projects, cost cutting. There's a lot of debt, a lot of leverage situations. It sounds like maybe distress situations. And you've gone in, and based on your resume, the impact of these is generally tens of millions in each project you've got in and delivered, whether it be banking, accounts receivables, reduction in expenses, etc. Is that your expertise? Would you say it seems a lot more execution focused?
You know, going into private equity, I would say that the first thing you have to realize, it's a 3 to 5 year assignment. It's rare that it's a 10-year or 15-year run for the CFO. A lot of private equity funds, when they buy a company, want to install their own CFO, someone that they've worked with in the past, but either way, they want to install their own CFO. They're always looking for people who know how to drive cash flow, who know how to partner with a CFO to create a streamlined and efficient organization. And I think I always think of it as having the same toolkit. You know, whether you're working in expansion or recession or growth or restructuring, it's the same toolkit you bring to the table. It's the level of urgency that you use to apply it frequently that's different.
Yeah. Can you talk to me more about the United Plastics situation? It sounds like you pivoted exactly what the kind of company it was before you had a pretty successful exit, going from loss-making to profitable.
So when I joined United Plastics Group, we were losing money. We were an automotive contract manufacturer selling into tier 1 automotive. So we were a tier 2 supplier. We were in many cases, hadn't executed price increases in a long time. And in fact, people didn't understand that we were operating under contracts that didn't permit us to execute price increases. When I uncovered this, I stopped renewing these contracts and started enforcing some discipline around pricing. But we were never going to make it as an automotive supplier, especially as a tier 2. And a strategy had actually already been developed and was on the shelf to convert to a medical device manufacturer. It required a substantial investment. We had to generate cash to do that. And the way we did that was very intentionally executing price increases on our tier 1 automotive customers. Tier 1s need to build a large bank of stock in order to shift suppliers. And we did that with substantial price increases. We made enough money on the exit of our automotive customers that we could build clean rooms around the world, invest in a medical sales force and a medical quality team. We got ISO 13485 certified, and then we went out and started winning these marquee customers like Medtronics and Smiths Medical. I say it in less than 3 minutes. It was a 6-year turnaround. It was hard fought. Sometimes it's better to be lucky than smart. We were already exiting automotive in the middle of the 08-09 recession.
Wow.
So we were already on our way to get out of automotive. So it worked out very well for us and for our sponsor, and we went through a great exit.
Fantastic. And we've been talking a lot about private equity. Your most recent role as a Pitney Bowes public company on the New York Stock Exchange. Again, it seems like one of the key projects delivered was a very material cost-cutting exercise.
Yeah, to be fair, I spent a short period of time at Pitney Bowes. I came in towards the end of the cost-cutting, but we executed. We were able to increase the cost-cutting targets and able to take out more costs than was originally anticipated. The other thing that I think I contributed there was a substantial improvement in our cash forecasting, in our capital allocation, and our operational reporting. You know, it's an under-recognized initiative and importance is capital allocation. When you're fortunate enough to be generating cash, how you spend it is equally important. And where you spend it, and developing a discipline around return on capital, especially on capital spending. And I think the other thing is really diving deep into what's driving cash and what's just costing money.
That's incredible. So what are you looking for next? Are you going back into the private equity market?
So I probably am going back into the private equity market. I've spent a lot of my career building teams. One of the things that's really important, I think, I actually just got off a phone call before we started talking, and it's all about the team. You know, even Larry Bossidy, who I was on the advisory board at one of the equity funds, always said, you get things done through people. And you have, I'm a little off your question here, but if you're going into a private equity investment, the first thing you have to do is assess your team. You have to make sure that you have the right people in place to execute your goals. And that's just so critical. And I just got off a call where the sponsor was telling me they had a weak team. We were talking about ways to strengthen it. But in the end, what I'm looking to do now, because I so enjoy building teams, is I'm still looking at CFO roles, but I'm also looking at operating partner roles within private equity, because I enjoy the mentoring aspect of what I do. I bring a solid process orientation to what I do. Comes out of Danaher. It's what made me who I am. And I find that building strong, repeatable processes and teaching people how to do that is incredibly rewarding. So I think I have a lot to offer
Yeah, absolutely. Absolutely. It sounds like it. So I guess on that note, I've got a few questions. We'd like to dig into your advice for the audience. We've got a lot of budding CFOs listening. And if you were parachuted into an enterprise organization and you had to rebuild the finance department from scratch, the kind of thing it sounds like you've done a few times, what would you focus on as the core things? And just as importantly, in what order would you do that?
Yeah. So what I would say is I've never, just to be fair, I've never had to quote rebuild from scratch. There's always pockets of good stuff in every company I've gone into. In many cases, it's unrecognized. But I have gone into companies with weak teams. And the first thing, so there's two or three things that you have to triage and act on immediately. Cash is the first thing. Where is the cash coming from and where's it being spent? That's just critical. Owning cash and owning that process is one of the most important things a private equity CFO can do. The second thing that I focus on is the team. Who are the stars? Who are the athletes? And honestly, who are the people that need to be top graded? And do we have simply too many people, and why? And that leads into the third area, which is what are the processes that are running? Are they efficient? Are they inefficient? And where are the pain points? A great example is I Care Partners, where I went in and I had some pretty good people in most of the roles. But I did have to top grade our revenue cycle management lead, our procurement lead, and we had to, but what was interesting is in treasury and in FP&A, I had good people who really just needed to be focused and mentored. And we were able to drive substantial improvement. When we redid the first cash forecast, the sponsor's exact words were, wow, before I felt like we were speaking a foreign language and now we're speaking English. So we're giving visibility. And honestly, as a private equity CFO, you have to balance two fences. You have to balance your stakeholders inside the company and your partnership with the CEO and your stakeholders on the board and at the equity fund. They are important stakeholders, and transparency is critical. That's what I love about it. I think it's a hard job, but it's what I love about it. I think there's one thing that you didn't ask, but I will share, is if you're going into private equity and your goal is, I'm going to make money on the exit and that's why I'm doing it, that's not the reason to do it. The reason to do it is because you love what you do. You read about the home runs in the paper. Most private equity exits are singles and doubles. And you don't always make your money, but you can have fun doing it.
Absolutely. That's incredible. I think that's in a lot of the business books, etc. It's not the people who love winning that win. It's the people who love the journey, love the process.
Right. Exactly. And that's a great way to phrase it. You have to love the journey.
Yeah. I think going back to your point, it was interesting. You said, step one, get the cash, control the cash. I was listening to a Jamie Dimon interview. Obviously, he's in banking, JP Morgan, but he's just said, since the beginning of my career, I create a fortress balance sheet, whether you're in a great economy or a bad economy, have a fortress balance sheet and a great team. When the inevitable recession happens, you always come out on top and people say you're lucky, but if you've just got your balance sheet strong, you become unstoppable in the long run.
Right. I've gone into a lot of companies where people've never had to deal with a tight cash situation. And my approach is always, we should be putting the tools in place now so that if we get to that situation, we're not scrambling to do it. There was a guy early in my career, his name, to the point you just made, his name was Tom Joyce. He was a division president when I was with Danaher, and I worked with him. He went on to be the CEO of Danaher. And one of the things Tom said to me that resonated forever is, if you understand the balance sheet, you understand the business. And it's true. I'm in the middle of writing an article right now about, and I haven't figured out the title yet, but the concept is the misuse and misunderstanding of EBITDA. Because what was a guy I talked to yesterday, he said he quoted me in a meeting, and he said EBITDA is BS and adjusted EBITDA is real BS. Because at the end of the day, it's cash that drives the business.
Yeah.
And adjusted EBITDA, depending on your debt agreement, has so many adjustments in it that it's nothing close to describing the health of the company.
Yeah, absolutely. Well, it'll be great to read that when it's out.
It'll be out in a week or two.
Yeah. Oh, fantastic. Fantastic. And Bob, I guess the next question is that there are plenty of finance professionals listening out there. What would your tips be to them on becoming a CFO?
It's a great question. I think that on becoming a CFO is stop looking in the rearview mirror, because you're not, as a CFO, you're not a bookkeeper, you're not an accountant, you're a business operator. And think like a business owner. Think like an owner. So, does the strategy make sense? How do you support the strategy? I approach strategic planning from the perspective of what is the top line, right? How are we going to get the growth? Or are we contracting, and what are we doing about it? What's our strategy around the top line? And then once we get that, then I start looking at what are the resources we need to achieve it. Be a business manager. Don't think like an accountant. If you're thinking like an accountant, you're lost from day one. Think like a business manager, and I've said it 100 times on this call already, measure your success based on cash flow.
Yeah. Absolutely. So I guess to flip the question another way, there's a transaction event, a new CFO comes in. Is that how to not get top graded and how to not get moved out?
I've walked into companies in a number of different situations. I've had some people come into my office on day one and say, I didn't get enough of a raise, and if I don't get one, I'm going to leave. And you have other people who are willing to prove themselves. And what I would tell you is that if you're going to think that your knowledge, your inherent knowledge of the business is going to get you a raise on day one, that's a losing argument. Because even if it gets you the raise on day one, I'm already looking for your replacement. You never want to hold a gun to someone's head. If you want to be successful and not get top graded out, prove your worth. Prove your worth. I've seen it, the best people I've worked with, they know they're good at their jobs, they know what they need to do to be good at their jobs, and that's what they focus on. They help me with onboarding, which is critical. As a new CFO, you walk in, you have 1,000 things coming at you all at once. The people who succeed, the people who get to stay, are the people who help you with the onboarding, steer you down the right path, and are really willing to listen. As importantly, as a new CFO, you have to be willing to listen. I always tell people that if you walk into a meeting, listen more than you speak. But prove yourself, prove your worth.
To that point, I mentioned this at the beginning, but with each of the roles you've had, or at least a lot of them, it seems that you've gone in, there's been very material projects kicked off, kind of above and beyond a lot of the value creation plans in the typical private equity transaction I've been involved with, seen, read about, etc. Does that translate to the first 30, 60, 90 days of much more heated meetings, people with different opinions on how the strategy should change? Because it still seems like there's a lot of changing goals, changing strategies to get to where you want to be.
So I think that, the level of urgency in the first 90 days really depends on whether it's a turnaround or are you walking into a stable company. When you're walking into a turnaround, everybody has the answer on what went wrong, but nobody has the answer on what to do to fix it. Or they have the answer on what to do to fix it and don't know how to implement it. Either way, it's not there needs to be a cohesive strategy that's developed. I have a pretty solid 30, 60, 90-day plan for onboarding. And it just starts with the core tenets that you and I have already talked about, which are, which really come down to cash, people, and process. But the level of urgency, it's really important as a CFO, as a business manager, that you're not spending all of your time with the finance team. If all you're doing is looking to the finance team for answers, you're not really learning what's going on in the business. You should be out visiting customers. What do customers value about your business? You should be out visiting vendors. How important, who are your critical vendors? Are you really partnering with them, and are they partnering with you? You need to get out of your office and spend time in the field. A lot of guys find that really hard to do.
Yeah. So if I go back to your earlier in your career at Danaher, you joined, and did you go straight into the finance team?
My first position with Danaher was a divisional CFO role.
Okay. And you had an MBA before that?
I did.
Yeah. Was there anything that the MBA helped you with? Did that change your mindset to be so pro getting out of the office, getting out of the finance team, speaking with the other teams, getting involved in strategy, execution, talking to the customers? Because you are very rightly pushing on that more than other CFOs and finance professionals I talk to.
So I would say no, the MBA didn't prepare me for that at all. I was very fortunate in that I had a controller working for me he had been in his job for 20 years. His desk hadn't moved an inch. And he was a Marine, a retired Marine. And I would tell you that he mentored me more than I mentored him. But on the other side, I was working for a CEO who insisted that I get out and meet the customer, and that I get out and travel with the sales team. So I was out on the road, and many of the customers knew who I was. And what that enabled me to do, because I had IT working for me as well, is that enabled me to develop tools to support our customers. How could we support our customers better from an information systems standpoint? We created ways, this was long before the World Wide Web, and we created ways to put data sheets in the hands of our customers electronically. We created ways for our customers to check stock, things that we take for granted today, but that I learned the value of hands-on. And I owe a huge debt to that CEO. I don't know where he is now. I'm assuming he's retired. But I owe a huge debt to him because he taught me these things.
Yeah.
I'm sorry, and to the customers that I met with, because they taught me a lot as well.
Yeah, this is the kind of stuff you might not get if you get your qualifications at the Big Four or elsewhere and then move into a big organization.
Yeah, and I'm a big fan of people, the good people who come out of the Big Four, and yeah. I've worked with some fantastic people at the Big Four, both on the audit side and on the value creation side. But what your education should do for you, it's not learning how to calculate present value or learning how to create a spreadsheet. What your education should do for you is it should teach you how to think and ask questions. Your education should teach you to be a critical thinker. And that's probably the most important trait that I look for when I hire a VP of FP&A or a controller or a business unit controller is, are you a critical thinker? How are you going to support whoever it is you report to?
Yeah, absolutely. I guess the ability to do the bookkeeping and everything else is far more commoditized, whereas common sense and critical thinking is a bit harder to come by.
Right. And I will always hire the athlete over the expert. Always. The athlete is hungry. They have a desire to learn. I consider myself a lifelong learner. I've yet to walk into a job where I haven't walked away enriched by what I learned. I've worked across industries and learned about everything from voting machines to garden products to defense electronics and automotive assembly and healthcare, delivery of eye care.
Yeah.
So, being a lifelong learner makes a difference.
Yeah, absolutely. Well, that's awesome. Next question, Bob. So for those listening, what pitfalls are there to avoid, and what are some of the worst things that you've come across in an exit event or a transaction event that the listeners can look out for in their careers?
So the pitfall as a CFO, the pitfalls to avoid are listening to only one person, so to speak. You often meet someone who's been with the company for a lot of years and they think they know everything. I'm a big believer in trust but verify. Okay? Because you have to get all sides of the picture. I think of it like a prism. And if you only look through the prism one way, you're not seeing all of the other things. What's the lens that you look through? Because a prism can have a very distorted view.
Yeah.
So, trust but verify. Look through every problem from many different lenses. The other thing you asked about exits and what to avoid. So one of the worst things that can happen in an exit is for data that you put into a data room to be wrong, to have errors in it. So one of the things that I always do is have a really strong quality control aspect to the data going into a data room. Being very crisp and clear in your communication, especially to a buyer, and being transparent and honest. When you try to spin something a certain way, it never works. It never works.
Yeah, absolutely. Trust but verify. I think Mike Bloomberg said, "In God we trust, but everyone else has to show me the data." So
Right.
similar,
Right. Exactly.
similar principle.
Exactly. It's the same principle, and it's incredibly important. It's incredibly important.
Absolutely. So I guess looking forward, we live in pretty volatile times. The macro situation is getting more volatile. Even private equity specifically, there's a lot of aging assets, there's a lot of dry powder, etc. The way people work, AI is transforming how people can work, particularly more people at the entry level, beginning of their career within finance. With all these moving parts in the markets, how do you see the future looking in the next 5-10 years for enterprise organizations, for the finance teams, and how would you recommend to an up and coming finance professional, someone aiming to be a CFO, to handle these challenges and these uncertainties?
So I think I'll first address what do I think. You're kind of asking me what do I think about the future in these difficult times, right? And the way I think about it is very simple. It's the companies that are nimble enough to be able to respond and that can think ahead. For instance, I was at Pitney Bowes when the tariffs started being implemented. I was fortunate to have an incredibly strong procurement professional working for me, and together we put together really good dashboards that said, if this tariff sticks, this is the impact on the business. Because what that did is it gave us the visibility for what are the actions we might need to take elsewhere in the business to protect the bottom line, right? So when I think about the future, it's be flexible, be nimble, and don't accept the status quo. Don't sit back and say, well, the tariffs are implemented. It's going to have a $9 million impact on our bottom line, and that's where we are. No, you have to go back to the business leaders and say, we have a $9 million problem. How are you guys going to help us solve this? And going armed with some ideas. Here are some ideas where we should cut costs.
Yeah. Critical thinking, going back to your point before.
Exactly. Exactly. Yeah. So I think that's the first part of your question is how do I think about that? As a CFO leading that, I think it's important to always be looking out in front and to be flexible and to know that you're going to hit a bump in the road. be ready. Because, I spent over the last 2 days, I talked to a handful of private equity funds, and I've talked about businesses that are challenged and businesses that are successful. And the businesses that are challenged didn't have that forward-thinking outlook. And the businesses that are successful today are businesses that are fundamentally strong, and because they've got the right leadership. And look, tariffs or not, businesses are going to survive, right? Having the right leadership to steward them through rough waters, being a private equity CFO and a partner to a private equity CEO is like steering a ship. A company doesn't turn on a dime. But if you can know what levers to pull and know in advance when you need to pull them, you're going to win.
You mentioned you've been talking to a few people in the private equity market. I guess more specifically, have you got any insights on what you think is happening over the next 1-2 years in terms of deals happening, transactions, how they're structured, etc.?
I think I think that deal flow itself is improving substantially. I think that it's going to be very sector driven. I can't sit here and prognosticate which sector will do well. Everybody's looking at AI, and again, I don't think AI is the panacea for everything. I think that but I think that deal flow itself is improving. I think private equity funds are starting to recognize that we may not get down to interest rates we had, and equity and debt ratios are going to adjust. The companies that I talk to that are in trouble today are typically over leveraged. But I'm very optimistic for the private equity market. I think that private equity owns so much of what we take for granted. Yesterday morning, I'll just give you a small story. Yesterday morning, I drove my car through a car wash, and I talked to the owner. He happened to be the guy standing behind the register. So you're the owner. And I talked to him. He said, yeah, my family's owned this forever. And I said, haven't you, car wash is an area that private is like the gold rush for private equity today. And I said, haven't you been approached? He said, I get approached every other week. Why would I want to sell? He said, I'm making a good living. He said, and the business has value. He said, there's a franchise. He told me there's a franchise car wash being put in directly across the street. He said, at a cost of $11 million to put up the building. He said, how are they going to make their money out? They're backed by private equity. How are they going to make their money? So I love talking to these small business owners because they have so much insight into the world.
Yeah.
And that's something I would tell any CFO, is that I actually learned this from one of my cousins. But talk to the people who run the businesses that you frequent. You can learn so much from them.
That tells you where the money in society is flowing to.
Exactly.
It's a better figure on the pulse.
Exactly.
Yeah. Fantastic. Well, Bob, this has been incredible. Oh no, actually, I've got one more question. I'd written down a note. I underlined something on your resume, if you don't mind. You've got that at Culligan, you waged a war on working capital.
So the war on working capital it's a Danaher process. Okay. And there's no rocket science to it. Okay. But what it is you create a dedicated space in your office and have a large visual management board. At Culligan, ours was broken into 3 columns: AR, inventory, and AP. And on the board, it was a whole wall. We put up a glass board so you could write on it with dry erase. And you put up your metrics. You put up what the root cause is and the countermeasures, and you have a stand-up meeting, whether it's weekly, monthly, whatever it is, bi-weekly, but it's a regular cadence. It's a stand-up meeting. It's not a finance meeting. It's often led by someone far down in the finance work, like the assistant controller might lead it. In our case, at Pelican, the assistant controller led it, and he was fabulous. But when you're talking about AR, customer service and collections are the ones presenting to the group, and the group is participating in active discussion. When you're talking about inventory, it's procurement and inventory management. And when you're talking about AP, it's procurement and payables talking about it. And the real value in it is, we called it a war on working capital because we consider that board a war room, right? And by bringing everyone together for a 30-minute max stand-up meeting, you're getting everybody focused on where are we, what are the issues, and what are we doing to fix them. And in that way, you have an AR issue, it's a balance sheet issue, it's a cash flow issue, but you've now made customer service a big part of your solution. People who interact with the customer on a daily basis. The solution may be as simple as, I'm taking an order. Did you know you have a $5 million past due balance? It may be as simple as that. It may be as draconian as deciding which customers we need to put on hold. But it makes everybody a part of the solution. And that's what makes it powerful.
That sounds amazing. I knew I had to ask about that the second I saw that. But yeah, Bob, look, this has been absolutely fantastic. There's been a huge amount of advice for our listeners, so I really want to thank you for that. And I think what really jumped out was your sense of urgency and driving into the execution in terms of operations and strategy, talking to other functions, talking to the customer, talking to the market, and thinking critically and going above and beyond the generalized finance function, which the audience will learn a huge amount about. But this has been incredible, Bob. Thank you so much for coming on.
Oh, it's been an absolute pleasure. Thanks for having me, Dan. It's been great to work with you.
Thank you. Thanks, Bob.